Hi, everybody. Welcome to this webinar. We are just getting started and I'm seeing people starting to pour into the room now. So we'll give it just a minute or so and give people a chance to get set up. But thank you all so far for those here for attending. We are live. It's great to see you all here. So yeah, looks like we've got a great turnout today. Thank you again, all of you, for attending and coming in. I'm really looking forward to getting into this topic and covering off some of your questions today. As everybody is starting to join us, I just wanted to say a quick sort of shout out that the 8th of March is actually International Women's Day. So a shout out to all the ladies in the crowd and all the ladies certainly in our company. We've got a fantastic team of amazing women in our team who do so much and add so much value to the organization. So thank you to you all. It's a pretty exciting time. So yeah, really happy to be able to make that acknowledgement. I can see we've still got a few people joining the room here. I'll give it another 30 seconds or so and I just will kick off, I think, out of respect for your time and those people who are already here. So maybe perhaps while they're still coming in, I'll give you just a quick introduction of myself, and I'll try to make this quick so I'm not boring everybody, but you probably mostly know my name is Simon Bedard. I'm the founder and CEO of Exit Advisory Group. EAG, or Exit Advisory, is a boutique advisory firm. We do a lot of M&A work, so specifically transactions, mostly representing sellers, people who want to sell their company and clearly maximize value. We do a bunch of other sort of advisory work, which includes, of course, business valuations. And so I always sort of liken it a little bit to using Google Maps. It's, I think everybody knows how to use Google. You open the app. The first thing it does is tells you where you are today. The second thing it does is you punch in where you want to go, and then usually it gives you 2 or 3 options on how to get there. And that's a really great analogy for our advisory. Where you are today is your business valuation. And not just what it is, but why it's that amount. Where you want to be is an exit plan. How you get there, there's a range of different strategic options, and that's strategic planning for you. So look, that's me. I won't bore you too much with my background, but I've certainly been involved around looking at value and companies for about 20 years now. So I'm probably showing my age a little bit with my haircut. So as we kick on, look, the reason we're all here today, of course, is to talk about business valuation. We're going to talk a little bit about why that's important. We're going to touch on the sort of typical methodologies and things that are used. And really, I think there's a lot of people in this webinar who will be thinking about growing the value of their company. And so we're going to cover off on some of the key things that will impact that. And I'm hoping that you will all leave today with some really valuable tips that you can go and start implementing in your business immediately. So certainly that's my goal for you. The format of the webinar is what we're calling a 2020. So 20 minutes of insights. This is not a lecture, right? We could talk about business valuation for days on end and bore you to death with technicalities. That's not what this session is about. I'm going to spend 20 minutes talking about some of the basics around valuation, some of the key things you need to consider. And then really I'm going to get into the questions that everybody's been asking. And, just on that note, thank you all for submitting your questions. We actually got completely overwhelmed with the number of questions that came through. So originally we were thinking we'd have a bit of time at the end of this session just to throw it to the floor. I'm honestly not sure we're actually going to have time for that now, just based on the questions we've had come in so far. Now, what we have done, though, is we have grouped those questions and tried to get the main theme. So look, if for some reason I don't answer your specific question today, keeping in mind here, by the way, we do have 2 more webinars in this series, the Business Growth and Exit series. So, look, if you have questions around how to prepare for sale and succession planning and, tax and legal and all that sort of stuff like that, a lot of that will come in the following webinars. Today we'll be primarily focused on valuation. So look, we'll get to those questions in due time, but there were some absolute rippers there, and I'm really looking forward to getting into them. On top of that, look, once again, if I haven't answered your question and I still don't address it today, there's plenty of ways to reach out, right? You can book a call with me. We can get on and talk specifically about your situation. I'm generally a pretty accessible person. So, or you can email me. We'll certainly do our best. I know our team is looking at all of the questions so that they can continue to create tools and further content and weave it into future events. So as I say, look, don't fret if it's not answered today. If your question's not answered today, we will certainly make sure we get to that for you. Now, just on that note around Teams and comms, you will get a couple of emails from us. We are not a spammy organization here. We don't send reams of emails all the time to people, but we'll certainly contact you after the event to let you know how you can get access to recordings and, really how you can reach out if you want to. So, so expect to see that. We also have a monthly email that covers buying, growing, and selling companies. So, so keep an eye out for that. We've always got some really interesting market data and other tools and things that you can implement in your business. On top of that, we do have an email that goes out just letting people know about the podcast. So if you're not familiar with the Buy, Grow, Sell podcast, really it is, I'm a little biased. I think it's a great podcast where we talk about how business owners acquire, scale, and ultimately exit businesses. But instead of hearing me drone on about these topics constantly, you get to hear it from other entrepreneurs who have come before you and really been there and done it. And what I actually really love is sometimes people do that full sort of merry-go-round of buy, grow, and then exit, and then they jump back on the merry-go-round and do it again. And so, the podcast is really about unpacking their story and understanding what worked, what didn't work, what are the key takeaways so that you can implement those kind of ideas in your business. And to give you an idea, look, I've had guests who've done everything from selling a business for, $1 million right up to guys who've sold into the billions when they look at across the multiple transactions they've done. So, there really is a range of sizes, businesses, industry types, regions, you name it. I think we're up to episode about 86 something now. So with a big tail of more people coming on the show. So lots of content there that I think can help you. You just need to pick the eyes out of it, take what works for you and start implementing, right? Because, as we all know, business growth is about execution and less about the theory. So hopefully that's all of help to you. But let's get on with the topic today because you're here to talk about business valuation. It is a bit of a favorite topic of mine. Why is it so important? Look, I have a belief that if you could only put one number on your dashboard that tells you whether your business is growing or not, it's actually your valuation. I think as business owners, we are kind of hardwired for growth and we love to look at the revenue numbers and we love to look at the profit numbers, and they are critical, right? I'm not trying to diminish that. We're going to see how critical they are, but they're pieces of the puzzle. And so you can actually grow value without actually increasing revenue and profit. So there's lots of different things to consider here. And clearly that's what we're going to try and unpack. So now one of the big things that plays into business valuation, and certainly if you're thinking about the value of your company or you're thinking about getting a valuation done, one of the big things to consider is why you want that valuation. Now, if you're just putting it up as a metric to measure growth and understand the big picture where your business is at, awesome. I'm going to give you some tips on things to put on that dashboard below that metric so you can track that and really drive growth into your business. But there's a bunch of other reasons why people might want to get a business valuation. And so I'm going to kick off with a quick little poll here, just out of interest to see from the audience, what is the primary reason why you are thinking about business valuation? Now, of course, I'm putting up the most common one up there is that I'm thinking about selling my business. Like that's usually one of the more common ones we see out there. And whether you're wanting to sell today or you want to sell in the future, look, value is going to be important. And so we can see the results starting to pour in now. Obviously, lots of other reasons there. You might be looking to bring in new partners or buy out old partners and stuff like that. And of course, we're always going to get some great advisors on here. So welcome, by the way, to all the accountants, lawyers. If you're out there serving business owners, then you're our people. We love you. We appreciate the work you do because, you know, in our world, the business owners are the heroes, right? They're the ones driving employment. They're the ones driving the economy. We need to do as much as we can to help them on their journey. So thank you all for attending. I can see now the polls here. We're looking at about 41% of people are looking because they're considering selling their business at some point. A good chunk of advisors here. Once again, thank you. Employee share ownership programs is another great one, you know, and I know some of the questions that came through specifically reference that, you know, when and how, and, you know, do you bring employees and maybe offer them shares, and certainly how do you value your company for that? So, you know, that's an amazing response rate there. Thank you all for contributing to that. There's a couple of none of the aboves. If you're the none of the above, please, I'd love to hear from you. Ping me a note if you can. If there's something that we don't address in this session, let me know, because it's, you know, we're trying to sort of cover the main bases here anyway. But so look, that poll looks like it's coming. Yeah. So look, selling certainly seems to be the lead reason there. That's fantastic. Well, look, whatever your reason is, you're going to get a lot of value out of this session, I hope. So yeah, look, we'll hit end on that poll for now, and we'll keep moving. So thank you all for completing that. Yeah, so let's get into it, right? We're short on time. You're busy people. You're running your businesses. What do we want to talk about here in terms of valuation? Well, I think one of the big things that I find when people come to me and ask me about valuing their business is what sort of approach and methodology they're meant to use. Now, if any of you have been out there talking to other advisors or reading stuff online, you may have heard something along the lines of, oh, you know, and get ready, we're doing our rule of thumb here, but you're in whatever industry, you're in manufacturing, you're in retail, you're in professional services, oh, therefore you're a 3 multiple. And that sort of broad stroke rules of thumb are used all the time. I think rules of thumb are an interesting one. They kind of come around because enough transactions have been done to form a simple average, right? And so they're there because of those sort of transactions, but they're also really quite misleading. You know, if you're just using a base rule of thumb to consider the value of your business, you may be doing yourself a massive disservice. And why? Because you could be leaving a lot of value on the table. Let me put it to you like this. You know, if I asked everybody in the audience here to rate whether they think they're an average company in their industry, below average or above average, you know, we're going to see quite a broad range of responses. Now, if you just think you're average run of the mill and, you know, no better than the average other guy out there, then maybe that rule of thumb will work for you. But I find with most businesses, it's quite a variable to that average. So I'll give you a great example. You know, we've been looking at a range of professional services companies. We've sold many of them over the years. In 1 year, we sold a professional services company that sold at a 1 multiple, and I sold another one that sold at a 6 multiple, and a couple in between. So, you know, which end of the spectrum do you want to be at is probably the question you should be asking yourself. Now, of course, one of the big things that people may be asking here is, well, you're talking about a multiple, but what is it a multiple of? You know, what are we actually multiplying? Now, that's the $64 million question here, right? And it leads into talking a little bit about not just methodology, but what exactly are you selling? Because you can use lots of different methodologies for coming up with a number, and you can also reverse engineer them once you've started with one. So it can be really, really confusing. I'll go to a little bit of formality here, but, you know, if you go to the international valuation standards, which sadly I am prone to read from time to time, you know, they talk about a whole range of different bases of value. You know, there could be equitable value, investable value, synergistic value, liquidation value. You know, what are we meant to use here, right? My favorite, and the one that I think is the most applicable and will be most applicable to this audience, is what we define as market value. Now, I'm not going to go into really heavy definitions. If you really want the international valuation standards, you can Google it and download it, or hit me up and I'll send it to you. It'll make some good nighttime reading for you. But in essence, market value is about selling an asset or valuing an asset at a particular point in time between a willing buyer and a willing seller, right? You know, and there's no extraordinary circumstances around that. What do I mean by extraordinary circumstances? Well, I had some e-commerce businesses that wanted to sell during COVID. Their numbers had exploded. Some of them had tripled their business overnight and then tried to sell saying, well, hey, this is sustainable, and everybody knew it wasn't. So, take out all the extraordinary scenarios. It's a normal environment. You have a willing buyer and a willing seller. Neither of them are compelled to buy or sell. That's, and you've also marketed to a reasonable audience. So we're not just talking one buyer and one seller, well, one buyer, of course, will only be one seller. But under normal conditions, what would that number be, right? That's your market value. Now, that's the first principle, right? Is understanding the parameters upon which you're going to look at the value of your business. After that, you can start to get into, well, what are some of the methodologies? Now, I'm not going to do death by PowerPoint here. I'm watching my time here because I'm going to hold myself accountable to that. So I'm going to talk through this. And if anyone wants more detail on methodologies, once again, hit me up. But the three most common methodologies you're going to see out there is the market approach, the income approach, and the cost approach. Okay. Now, once again, I'm not going to go through all of these in micro detail because the most applicable approach for most of you, and I'm going to give a little caveat here, is that I'm going to assume most of the people, most of you on this call right now, or on this webinar right now, are looking to grow and maximize the value of your company one day to potentially exit, whether you sell it to a third party or hand it down to your kids. You're looking to grow and maximize value. And if that's the case, in most cases, you're going to be looking at using the market approach, which in other words says, if you're a professional services company or a construction company or a SaaS business, whatever it might be, you're looking at how are businesses in my sector traded? What does that normal environment look like? What is a normal transaction based upon? That's the market approach and will be used by most people on this webinar. Of course, you do have stuff like the income approach. Many of you may have heard of something called discounted cash flow. Look, it's a fantastic model. It's used all through corporate finance all over the world. Typically used more in very large transactions. You want to sell big infrastructure assets with long cycles and consistent cash flows and things like that. Discounted cash flow is brilliant. For the average small to medium business, and what do I mean by small to medium? I'd say if you're turning over anything up to about $100 million, you're probably not going to use DCF. Now, of course, there'll be exceptions to the rule, but this is just some guidance too. The cost approach, well, look, you could be talking about replacing the cost of your assets, reproducing assets. There's another method called the summation method. I'm not going to get a lot into that only because I don't feel that most people, certainly in this audience, are looking just to flog the assets of their company and just sort of scrape away and get what they can. You're looking to enhance value. You're looking to capture value. And that means looking at all those qualitative variables that we're going to get into shortly to talk about how to boost that number, right? And how to boost the value of your company. So methods, right? Basis of value would be fair market value. The method would be the market approach, saying how are businesses typically traded in my world? And then you're going to get into, well, what does that actual method include? So here I'm circling back onto multiples and things like that. And I'm going to give a couple of examples, right? Because I do think that this throws people off. And in fact, one of the questions we got was, how do you value a business aside from the usual multiples? Well, the person that asked that question, I wonder if maybe you had a rule of thumb in mind, and perhaps you've probably seen a lot of rule of thumbs out there. Let's talk about some common multiples, right? So the most common is some sort of multiple of your profit. Now, I'm going to get into this one a little bit more in a second, but you're multiplying your profit by a number, right? And this is where the magic number of 3 seems to pop up a lot. So multiplying profit. Another variable you could see out in the market is stuff like multiplying your revenue. Now, of course, any business owner, looking to exit one day is probably rubbing their hands and saying, I'd much rather a multiple of my revenue. Of course, as I said before, these methods can all actually be applied to any business. Once you've worked out a valuation based on your multiple of your profit, you can reverse engineer a multiple of revenue, right? So it doesn't necessarily mean you're getting more money. It's just a different way of triangulating your numbers and working out where it might sit. So once again, don't want to get too technical on some of that sort of stuff. for the most people on this call, you are more likely to be selling your business as a multiple of profit. Now, the question is, even here, what do we mean by profit? Because this is a really confusing thing. Is it profit after tax, before tax? In fact, I'll jumping into another question, but I had somebody asking me the difference between EBIT compared to EBITDA. How do we look at that? And so I do have one slide that I'm going to share with you today. I'm hoping it's not too technical, but I think it's going to help you understand the difference or the different types of profit that you should firstly understand as a business owner, but secondly, picking what you should be using in terms of your valuation. So I'm going to try and share a screen here and hopefully not completely screw it up. Give me 1 second. I love playing with tech. Here we go. And a quick share. That and share screen. Now, I'm hoping you can all see my screen. Now, if not, you should have, now I'm dancing around a little bit. There's a table. Now, we're talking about profit here, right? So up in the top corner, you can see profit. What does profit typically mean? Well, let's go through the standard P&L calculation, right? You've got, well, here we go, revenue minus your cost of goods or cost of sale equals your gross profit. Pretty straightforward. Most people are still with me, I hope. Minus your total expenses gives you your net profit before tax, okay? So most people are comfortable with a standard P&L, so we won't harbor on this too long. However, we don't want to multiply just your straight profit in a valuation calculation because you'll be leaving a lot of money on the table. Instead, what usually happens is we're looking at what we call EBITDA, or EBIT in certain industries, but just roll with me here for a minute. So what does EBITDA mean? First of all, let's define it. So it's earnings, so your net profit, before the impacts of interest, tax, depreciation, and amortization are impacting your bottom line. So in other words, another way of saying this would be your earnings without interest, tax, and all those factors being brought into the equation. So let's work through an example. We've talked about earnings. Well, let's look at our net profit line here. Of course, that net profit line is already your earnings before tax, as we've stated there. Now, what we need to do is now isolate the impacts of interest. In this example, 27K. You've, of course, removed tax. We've all then got to move on and find depreciation and amortization, which in this case is 40K. So add those two things together is $67,000. To come to your EBITDA, you would be basically adding these numbers back in or adding it to this bottom line. So your EBIT or EBITDA in this situation would be 765. However, that's not the number you want to multiply because most businesses will have an adjustment to their financials. Okay, I promise you this is as technical as I'm going to get, but if you have any non-operational expenses going through your business, or you have what we would call any sort of one-off significant items that aren't going to be a recurring theme or expense in your business, then we need to remove the impact of those on your EBITDA. And obviously what that would do is it would increase your EBITDA and in turn increase your valuation. So what's an example here? One of the classics I see a lot of is motor vehicles. And as you can see there, we've written it's for personal use only. It's got nothing to do with the business. So we would want to remove the impact of that motor vehicle out of the financials. So we're getting to a proper adjusted EBITDA. Okay, so what does that look in terms of the calculation? Pretty simple. We got 40,000 plus 27,000 plus 18,000 gives us $85,000. Once we add those back in, we move from a net profit number, of course, to an EBITDA, or in this case, it would actually be an adjusted EBITDA of 785. Now, I don't know about you, but I would much rather multiply 785 than 700 if it's my business. So hopefully you can see the value of this exercise. Now, of course, I'm doing this super simplified, right? And I'm going to stop sharing now because I think you've all probably got the point of that. And Let me find my little screen and stop sharing. There we go. What the process I just took you through there is, especially with removing personal and one-off costs, is called normalisation, or making financial adjustments. The accountants in the room will know all about this, and undoubtedly are working with their clients to hopefully not have too many financial or personal, expenses going through the books. But as we know, it does happen in a lot of businesses. Now, one thing I will say, if you are selling your business, just because you need to make adjustments doesn't necessarily mean you won't be able to sell your company or you won't be able to capture value. But if you're showing an actual loss for the year and you're adding back $1 million worth of expenses, it's probably not going to go down so well, right? Like it's pretty maybe not quite as believable as somebody who's just making some minor adjustments. So running your business as your personal cash register can have an impact. It just doesn't mean that you're completely unsaleable or we can't put a proper value to your business. Okay, so keep that in mind. So what are you doing? So most people, when they think about the valuation of their business, they're going to be looking at a multiple of their adjusted EBITDA, okay? Now, of course, the magic number here is, what is the multiple? Now, we talked a little bit about industry averages before and rules of thumb. But if you looked at the average industry pick, and you can pick one, they all have general rules of thumb, but they all have ranges within those rules of thumb. So, and the ranges come from actual transactions, right? So using that market comparable sort of method, what we want to understand is, if businesses in your industry and are typically of your size doing the sort of things you do, trades between a 2 and a 6, well, what are the variables in your company that would determine whether it's a 2 or a 5 or a 6? And so we're going to get into some of those qualitative factors right now. Now, one of the interesting factors with those qualitative assessments is sort of qualitative and quantitative is actually how big your company is. So recently I was looking at a couple, well, we're selling a couple of wholesale businesses right now. Some of them do about 5 to 10 mil turnover. Some of them are doing closer to 100 mil turnover. When you look at those businesses, they could be identically the same in terms of what they sell and how they sell and where they sell. But the sheer fact that one is much larger, it will get a better multiple, not to mention probably a bigger EBITDA as well. So one of the key factors here is that size matters, right? And if you think about why, well, I mean, take some of the bigger buyers out there, right? Private equity, they won't play around in smaller businesses, right? If you were selling to a large listed organization and you're only doing a couple of mil turnover, unless you've got some piece of critical IP, they're probably not going to buy you, because the cost of doing the deal, the due diligence and everything else just makes it not worth their while. So bigger companies tend to attract bigger buyers, and there tends to be bigger valuations. So, and that leads me to a really great poll question here, which I'm going to launch right now. I'll say stop sharing that poll. Hopefully that hasn't been up this entire time. And here we go. How do we get to our next poll question? That's an interesting question in itself. Okay. All right. Of course, I can't seem to find that. So that's all right. Look, the next poll question was simply going to be, what is your revenue bracket? Right now, if you're in the sort of 0 to 2 mil space, and by the way, actually, this is a probably good time to answer one of the questions that we got was around pre-revenue businesses. Look, today, a lot of the principles I'm talking about aren't necessarily going to work for pre-revenue companies, right? They're sold on, all sorts of different variables, because you can't multiply a profit that doesn't exist, and you certainly can't multiply a revenue that doesn't exist. So, the principles here are more for your typical established companies. But what we often see with the size of these businesses is that, if you're under 2 mil, you're really at the bottom end of those valuation ranges, those multiple ranges. 2 to 10 start to move up a bit. I find over 20 million as a broad general rule starts to get a good uptick, and you might go from a 3 to a 3.5 to a 4 just based on the size alone. In fact, we analyzed data from over 60,000 transactions and found exactly that. The businesses over 20 million compared to businesses turning over less than 5 million got about an extra point in their multiples. So interesting stuff. What are some of the other variables? Well, And I'm cognizant here that I'm running out of time, but this does lead into some of the questions that are being asked already. One of the key ones, of course, is what are some of the few variables or attributes that people are looking for, and ultimately drive value. One of the things I'm going to say to you, when you think about your business and you think about building value, the first lens that you should really look through is one that's, and it's almost the yin and yang symbol here, right? One is what is the growth opportunities, and one is risk, right? And they're two massive factors here. If there's not much growth in the future of this business, it might be incremental. You're just pinching a little bit of market share. The total available or addressable market is not huge. You're not going to get a huge multiple. It's just the reality of it. People are buying your income stream, and that's basically it. Unless you have other sort of strategic value that sits behind it. If you've got an enormous market and you've tapped 1% of it, and there's just so much more that a bigger buyer could do and capture by applying their assets and their own skills, well, that could be worth more to them. Having said that, it's still a negotiation, right? So that's only one key point. The risk factor, and this is a critical one because it's one of the major traps that I find most business owners fall into, is that they've been operating their business for a long time. They no longer see the risks in their business. You can't see the forest for the trees. I'm going to give you a different analogy, is that flying in planes. If you're absolutely petrified of flying in a plane and you're getting onto whether you're in Sydney, Melbourne, whatever, and you're jumping on a plane to go for a little flight, the risk of that flight is no different between you and the pilot, but your perception of that risk is going to be very, very different. Okay. And so you will react differently to it. And what I find with most business owners is that they're so comfortable running their business that some of the risks in their business that are real risks, they just sort of almost a bit blasé about it because it hasn't necessarily happened to them, so they don't worry about it. Whereas an external person coming in and looking at the business may see alarm bells going off with various sort of risks, whether it be operational, systemic, market risk, all these sort of variables. So how risk is looked at in your business is critical to how the valuation will be calculated. One of the tips I'll give you as business owners is, when you're sitting back and probably in a more relaxed state of mind and you're thinking about your business and you're thinking about the areas that kind of don't work as well as you'd like them to, everyone uses the, what keeps you up at night factor. Look, if it's honestly keeping you up at night, then it probably is a very major concern. But try to put yourself into the shoes of a buyer for a moment and say, if I was to come along and try to buy my own business, if I was acquiring this company, what are the things that I would pick on with all the knowledge that I've got? All right. What would you pull apart? What would you tease? What would you frankly use as a negotiation tip or tactic against yourself to try to push that value down? Because you'll know your business better than anyone. And if you can identify those risks, then you can start to actually work on them. Perhaps, of course, prioritize them if you've got more than a couple. So think about your business in terms of the growth opportunity and the risk lens. Ultimately, risk comes down to, if somebody is buying this business, they are buying your future stream of profits. What is the risk that this business won't keep doing what it's doing? What is the risk that they won't be able to realize that growth opportunity? So lots of factors that come into that. Now, I'm going to share a couple with you, a couple of specifics, because, look, I could be here all day talking about a whole range of them. But I'm going to touch on a few that I see happening a lot, particularly in private business. The first one is key man risk, and typically relating to the business owner themselves. You're the expert. You are fantastic at building widgets and selling widgets, and you know every application of the widget. In fact, the special sauce and how to create those widgets is buried in your head. If you got hit by a bus, the business may stop. B, how many hours a day, by the way, can you put into your business? Like, are you actually scalable, or is the business totally dependent on you being that special ingredient into whatever it is that you do? So key man risk. And by the way, it doesn't just impact valuation, it also impacts the terms of your deal if you decide to sell. So I don't know about any of you, but if I was to sell my company or companies, personally, I'd love to sell it and get all cash up front. That may or may not be a realistic expectation based on my company, but I think most people would agree they'd rather be able to take their money and know that it's protected and not have to worry about anything or hitting performance targets. So, the more dependency on you, the more it impacts the number and the terms that you would get around that number. Now, the second big mistake around key man risk that I see is that business owners try to transfer that that key man risk from themselves to a key employee. Now, it's highly unlikely you would ever find somebody out there who can do exactly what you do, how you do it, when you do it, and have all your instincts around the business. It's your business, it's your baby. So don't go and try to find a unicorn to replace you with, because first, it's not going to happen and you'll be disappointed. Two, all you've done is transfer the risk from yourself to somebody else. And by the way, I have seen it in transactions where that key employee has suddenly realized their importance in this transaction, and it was unpleasant to see some of the behavior after that. So don't put yourself in that position. You may have shifted some of the risk, but it doesn't necessarily mean you've increased the value, because let's be honest, buyers and certainly their advisors are going to be pretty smart and they're going to understand that. So they'll still ping you. So don't transfer risk. Don't go from a key owner risk to a key employee risk, right? And while we're talking about key risk, the other two factors in this variable is suppliers and customers, right? And I'll share a couple more basic guidelines around some of this, but if you let's say that 75% of your revenue comes from selling products from one supplier, like you're massively overextended or overcommitted to that supplier. You've got massive concentration. And if something happened to that supplier, your business probably wouldn't survive, or it's certainly not going to look anything like it did. So thinking about that, thinking about your supply lines, if you have supply lines, for those of you who are professional services companies, really your supply is your talent pool, right? So comes back to that, not having too much risk or concentration on one employee. It's about, having maybe perhaps multiple people in a senior leadership team that can deliver value, right? And that will de-risk you fundamentally. Of course, if concentration risk is a problem with suppliers, it's also a problem with customers. As a bit of a general rule, I always, when I'm looking at financials and businesses, if I see a client has, of course, I ask to see all client revenue by client, but if your number one or your top client represents more than about sort of 10 to 15% of your revenue, I start to kind of get an uncomfortable feeling. If it gets up to as high as 25, I've got red flags going up. If you're kind of going over that, 40 and 50% and certainly above 50, it's not just red flags. I've got alarm bells going off. It's flashing. It's crazy. So, that's massive risk. And by the way, in some cases, I've seen it actually stop sales going through. It hasn't just impacted the valuation. So it's a really critical factor. You really want to make sure that you're not, you don't have concentration at either end of your kind of supply chain. So there's a couple of big ones. Are there exceptions to the rule? Of course there are. But if you're going to go out to the market, those risks there are going to be some of the key things that people are going to look at. Now, I'm going to share one other important factor here. And look, I could give you a list. In fact, we've got checklists of this stuff. So reach out. I'm sure the team can send you some more resources and downloadables and all that sort of good stuff. But I want to pick on one last major risk factor before I jump into some more questions, or one what I'll say is a qualitative variable here, and it's the quality of your actual earnings, right? We're not just talking about the quantum, I turn over X, I'm over 20 million, all those sort of things, like they have an impact from a size perspective, but it is the quality of those earnings. And it's, what do I mean by that? Well, what is your gross margin? What is your net margins, your EBIT margins? What do those percentages look like? How do they compare to your industry or your peers? But also, what is the story that your financials are telling you, or telling me and telling buyers? I've got a client that we're selling right now. They are a SaaS company. They have consistently grown by about 30% per year for the last 7 years in a row. 90-something% of their revenue is recurring revenue, and that's something I'll touch on a little bit more. But the profile of this business, they are basically increasing their profits every year because their cost base, a lot of their cost base is fixed. And so revenue's going up, profits are going up, profit margins are increasing, and it's just this beautiful line, right? It just looks like it's going to keep going forever, which, okay, we all know that's not true, but the perception for the buyer is, hey, look at how stable this is and how consistent this is. It's a fabulous story. The company, by the way, is also spitting out cash. And this, if you haven't heard the term free cash flow, it is an important factor. If you're selling a cafe and little things like that, I mean, some of this terminology won't apply to really, really micro businesses, or it does, but people don't factor it in. But if you've got a company that is turning over more than 7 figures and you're in a range of different areas, thinking about the available free cash flow you have to reinvest into your business, or frankly pay dividends if you wanted to, is going to be a major factor. It's certainly the factor, one of the biggest factors that private investors and private equity will look at when they're considering investing in your company. So the quality of your earnings, there's probably an entire 3-part, 10-part webinar series we could do on this. For any of the accountants in the room, please let me know. I'd be happy to jump on and do some more sessions and talk through it with you, but it's, for the audience. Yeah, quality of earnings, guys, really, really massively important. And final little point on that, I did mention recurring revenue. If you think about the idea of recurring revenue, it touches on that massive risk factor that I talked about. If people are buying your future stream of revenue and profit and then saying, well, what's the risk that that's not going to keep doing what it's doing? Recurring revenue models answer most of that question, right? Hey, we have clients who once they subscribe, we take the money automatically from their credit card. We keep doing that until fundamentally they have to write to us and cancel a contract. They have to physically do something. Typically around recurring revenue models, they can tell you what their cost of acquisition is for new customers. They can tell you exactly what their churn rate is, and they can start to very predictably project or forecast where they're going. So that to me sounds like a systemized money-making machine. And that is why you see software companies trading at completely different methodologies than your traditional business, okay? SaaS is one of those ones we talked about early in the webinar about, are we multiplying profit or are we multiplying revenue? SaaS companies are often trading on a multiple of their annual recurring revenue. In fact, we've done a number of SaaS companies in the last year, and they've traded anything from typically about 4 to 6 times that annual recurring revenue. So one example, 1.5 million turnover, 250K EBITDA adjusted. We sold that business for 9 million. So 6 times annual recurring, sorry, it was actually 12 times annual recurring there, but it's, and it was like 28 times or something. I'm going off the top of my head here, but it took about 28 times EBITDA. So it's just crazy numbers, right? It's not the sort of stuff that you will see in a traditional business. Now, having said that, I've had a few software people say, well, 6 times, that's a bit low. And I think if you're looking online and you're watching all these unicorns and big global deals happening, certainly the numbers can be astronomical. But I think for the most part, we need to work within the standard variables that people are more likely to see out there. So recurring revenue. And look, if you are saying or thinking at the moment, hey, my industry doesn't work like that, my business doesn't work like that, I can't do recurring revenue, I want to challenge that thinking, because I am yet to see a business that can't apply one of the types of recurring revenue models to at least a portion of their business. You go to value it and you can say, well, look, 30% of my revenue is on this recurring revenue model. The rest of it is traditional. It still adds value. So give some thought to how you're structuring that in your business, or certainly how you think about your business model going forward. All right. I've been weaving some of the questions into what I'm saying here. So hopefully some of you are picking up on that and feeling that your questions are getting answered. Let me jump in and just answer a few more directly, because we've hit time. I'm certainly happy to stay on and keep going for a little bit longer if you guys are. And so I'll just plow on. Let me find some of these good questions that we've got here. How important is adjusted EBITDA compared to just EBIT? I think we've answered that, right? EBITDA will typically give you a better number to multiply. If you don't have depreciation in your business, well, it may not be a material thing. Some industries, by the way, do trade on multiples of EBIT versus EBITDA. So you just got to understand what happens in your market. Another question, how far back do valuers look when establishing the value of a business? Really good question. The answer is, it depends. Typically when I'm doing a valuation, I'll ask my clients to give me the last 5 full years. So P&L, balance sheets, the works for the last 5 full years. If we take today as being the line in the sand, I would say I also want to see the current year to date up till, 8th of March, till the end of Feb, for example. I would want to know their forecast to the end of this current financial year and preferably their forecast for the next financial year. Now, that forecast for the next financial year might be a little more high level, but if we're sitting here in March and you can't tell me where you think your business is going to land by the end of the financial year, that says risk to me, right? So that's one of the factors. And to answer the other question around how far back we go, well, do we do all the normalisation and all that accounting work or those calculation work there? Absolutely. We want to understand what we're playing with here. And, hey, if your numbers have just been doing that, nice growth, stable, steady, wonderful. A lot of businesses we look at, they've got these variables, right? Especially with things like COVID, they might have had a couple of good years and a couple of bad years, might have bounced back, could be the opposite depending on your business. It's important for you as a business owner to understand that when we see lines like this, it's volatility, right? Volatility means uncertainty, and uncertainty means risk, and risk means, lower valuations. And it's a direct relationship, right? Higher the risk, the lower the value, lower the risk, the higher the value. So if you only take away one tip today on how to build value in your business, it would be this. Understand the risks in your business and how to mitigate them, and you will put yourself in a much, much better position than your industry peers, okay? Understand risk, learn how to mitigate it, and learn how to talk about it too, right? I know with buyers, when they're looking at companies, they don't expect your business to be perfect, right? They don't expect that you've got no risk. They don't expect that you've just got this amazing solution that's perfection. They expect you to have some issues or have challenges, right? But what they're looking for is that you've got a well thought out, first of all, you have a good understanding of those risks, and you've got a bit of a thought out plan on how you might approach it going into the future. So one of the key factors there. Let's move on. How important is directors' income when valuing a business? Look, another really good question. It probably comes up more at the smaller end of business valuations, where sometimes directors don't pay themselves a salary and then they just pay themselves out of profits at the end of the year. Now, that in itself doesn't mean that you can't value the business, and it doesn't mean that you can't sell the business. What it does mean, though, is that buyers and valuers are going to pull that apart and take a little bit more of a look at it. If you're a director working 40 hours a week, 50 hours a week more, what I would do as a valuer is say, what would I have to do, or what would I have to pay to replace you in this business? So if you're not paying yourself a wage, but I would have to hire a general manager and pay them 150 grand a year, well, that 150 grand a year is now going to be an adjustment in those normalizations, in those financials. So if you go back to this, or think back to the slide we did, we found a whole bunch of expenses to pull out. In this particular case, it's an expense that I'm putting back in. So it's actually going to reduce your EBITDA and reduce your valuation. Now, it doesn't mean that you shouldn't do it because you're worried about reducing your number. What I'm saying to you is this is just one of those really, really obvious things that if you're not managing it properly to begin with, it just gets adjusted for. It's not something that will fly under the radar and not get picked up. Okay, so how important is directors' income when valuing a business? It's critical. It's critical. Unless you can 100% prove to me you don't work in the business, you have nothing to do with the day-to-day operations, you pretty much don't spend any time on it, someone's going to factor in a wage for you if you're not already doing it. And by the way, if you're already doing it, there's still an assessment of, are you paying yourself a market-based salary? Once again, if we had to replace you, could we do it at the same level, or is there an adjustment up or down? So major factor when it comes to normalizing your financials. Next question, what are the key attributes that attract buyers to a service-based business? Look, great question. Probably Probably some of it I'll cover off in one of the future webinars in terms of how to prepare your business for sale as well. But look, what I would say is what makes you attractive to a buyer? Well, we touched on it before. Future stream of revenue and profit is one factor. But the other factor is, like, what problem do you solve, not just for your clients, but what problem could you solve for the acquirer? How big is that problem for them? Facebook, all these big, large organizations are doing acquisitions all the time, and they're often buying little pieces of tech that plug a hole in their production line or what in their service offering, basically. So one of the things that you can think about is, if you're going to sell one day, who could I potentially sell to, and what problems could I solve for them that would make me more attractive? Okay, I'm going to share a quick story with you. A lady by the name of Stephanie Breedlove. She had a business that ex-consultant, PwC, all the rest of it, went on maternity leave, hired a nanny, wanted to have the nanny put on a proper payroll system, couldn't get a payroll system set up for one employee. So she created a business that did payrolls for nannies. I mean, like, talk about a niche within a niche. She ran that business for, I think it was 17 odd years. It was turning over about 9 million. If you presumed that she was doing a standard sort of EBITDA on that, maybe she was doing 1 million, you might multiply her valuation by 4, 5, even up to a 6, something like that. So maybe she gets 4 to 6 million. What Stephanie actually did, though, is she went to a company called care.com, who had an enormous market share around care, everything care, age, disability, all the rest of it. Stephanie was able to actually say to them, she had 70,000 clients. They had 7 million clients. And she basically managed to pitch them and say, well, when you buy my company and offer it to all your existing clients, if only 1% of your existing client base took my solution, you would double the size of the business overnight. In the end, Stephanie sold her company for $54 million. It's one of those strategic levers that can come into play with these sort of things, where she could demonstrate clearly that she could solve a problem for them, that problem could be immediately answered and rolled out, and she was able to then negotiate that she should capture some of that value. Not a traditional metric, not the sort of exit that most people are going to do, but hopefully it underscores the principles that I'm talking about when I say look to solve a problem and look how you might become a very good target for a much larger organization. Because I'll tell you one thing, big companies, like all companies, have only 2 levers when it comes to growth. They either build it or they buy it. And I can tell you, most large companies, they'd much rather buy it. They can access cash, they can access capital, they can do all this sort of stuff. It's quicker, it's simpler. Building and competing in the market, that's hard. That's what most of you guys are doing. So you can demonstrate that value. You can then capture that value if you present it in the right way. What is the application of ChatGPT? We've not got long left. I've only got a couple of questions. So I love this one. I included it, application of ChatGPT. What will it change? What will it create? I presume the question related to business valuation, but it could probably relate to the entire topics in this series. Look, I probably, like a lot of people, I'm fascinated with ChatGPT. I don't spend as much time on it as probably some people in our team, but I love it. And the short answer is AI is going to change everything. But by the same token, there are certain things that AI will not be able to do. It certainly can't have relationships with people. So that's something to consider. But if you're looking at process-driven stuff and you're looking at how to manage information and collate information and analyze some information, it's going to be amazing. Could an AI tool normalize your numbers for you? Not without your input. So, there are variables, and I think we'll see a lot of changes coming down the line, not just with valuations and business sales, but holistically across most markets. Okay, pivotal factors influence multiples. I think we've touched on some of that. One of the questions here was if we're a rapidly growing business sector with industry consolidation going on, how can we value our business to include and the question dropped off. So I get where you were going with that, though. And it kind of relates to one of the big final topics that I'm going to cover in a second, which is timing. Timing is one of the most important things. It's so realistically, if you're a business, whether you're just a startup, whether you're, still got a burn rate, but you've got customers, or you're established and been around a long time, timing is going to be critical. In fact, it's probably one of the most critical factors. And why do I say that? Because we're all very, very small boats in a very, very large ocean, right? What's going on in the broader market will determine whether there are opportunities for businesses or not. And we saw this in COVID, right? Some businesses literally hit the wall, shut down, gone. Other businesses, massive opportunity opened up and they boomed. So part of that is the market dynamic, and part of it is the timing within that market. So if you think about, there's a couple of kind of key elements here, and three buckets you can consider for yourself. One is the macro environment, and everybody's heard of a pest analysis and all this sort of stuff, political, environmental, social, technological, legal sits within that as well. What is going on in the macro environment? What is going on then in your particular market? So in other words, how does your broader market, your competitors, et cetera, react to the macro market? And then what's going on inside your firm? Now, a lot of the stuff I've talked about today is what's going on inside your firm. The market itself and the macro environment are two enormous variables that will determine whether A, in some cases, whether your business is saleable, certainly B, whether it's a good time to sell or not. We've had businesses that have gone to market and come off because just the market wasn't right. A lot of the buyers were in a bit of, whether they're in a pickle or just had a negative outlook on the environment. Remember here, perception is reality, right? For these people, whether the sky's going to fall on our head or not is almost irrelevant. If they think it is, it is. So perception of the market is critical. And it's why you need to think about lining up your ducks when it comes, if you are going to sell, and you are building value. How do you actually present these things? Because you only get one chance to make a first impression, right? You only get one shot at having that engagement with some of these buyers, and you want to put your best foot forward. So, so timing, the importance of it, I'd say utterly critical. It can mean everything or nothing. A little bit of a guidance in terms of how it can impact your value, and a couple of principles you can take away with you today. One, when is the best time to sell? Typically, I'd say when there's more buyers than there are sellers. If there's more buyers, there's going to be more money, valuations go up, and we saw that over the last couple of years. In fact, they've come off back to sort of more normal levels about halfway through last year, but there was about 18 months there where valuations were booming and they were over long-term averages. So more buyers, supply and demand, pretty simple stuff. The other thing I'd say from just a broad sort of timing perspective is you need to ask yourself how long you want to keep doing what you're doing. If you want a certain valuation and you're not there yet, how long would it take you to get there, right? So timing and valuation are intrinsically aligned, right? But, and this is answering somebody else's question about, headspace and being ready to sell, or, when do you know? One thing I would say to you is that there's kind of two valuation numbers you should be aware of. And I'm not talking about a formal valuation here. I'm talking about instinct as a business owner. And that is, what's the business worth to me? And what's the business worth to the market? And if at some point in your journey, it's worth more to the market than it is to you, my advice is sell, because that dynamic could change tomorrow. And you may want to get out in 12 months and you can't, because it is no longer meeting your financial needs. So I'm not going to go into financial planning stuff here, because that's a conversation for another day. And I'm not a financial advisor, nor am I an accountant. So there's some more disclaimers from me. But think about valuation, think about how value impacts you in your personal life. Think about what that number should look like. And by the way, if you're doing back of the envelope numbers on this, you're doing yourself a disservice as well. But if your business is worth more to the market than it is to you today, it's probably a good time. And that's probably a great place to end. I hope you've all gotten a lot out of this. I was going to put up a little poll and ask you how, just for some feedback. The team will probably throw that on an email. So, all we ask is give us a NPS, a 1 out of 10. Would you suggest this webinar can give value to other people? One thing I will say just at the end here is, if you would like to book a session, something we've thrown out and we've done before, and I think is a worthy cause. If someone wants to book a session with me, you can go online and do that. The only thing I ask, I'm willing to give you my time, but I'm asking people to make a very small donation, which goes to Kiva. If you're not familiar with Kiva, Kiva enables micro loans to basically underdeveloped countries. EAG and Buy, Grow, Sell as well is a big supporter of Kiva. We've done hundreds of loans across something like 50 countries. Some of these people only need a couple of $100 to get a basic business going so they can feed their family. It's a wonderful cause. It's relating to business owners, and it's something that's very passionate to me and our team. So if you'd like to book, we ask for a small donation there that will go all 100% to Kiva. And yeah, look, happy to book a time, answer your questions, and obviously target that very specifically to your situation and your needs. So, so that's basically it for today. If I can wrap up with one little final point, as people are probably getting ready to leave, if you'd like some more case studies, hop onto the podcast. Keeping in line with the theme of International Women's Day, a couple of great ones. Nikki Senyard, she's actually Australian. She built a business, had a really terrible failed attempt at an exit, but ultimately sold her business. And it was something like a $40 million valuation. Another lady, Gabriella, built a couple of SaaS companies as well, probably picking on SaaS a bit because they're kind of a bit sexy and sort of certainly in the theme of things at the moment, or certainly in the press a lot. But there's lots of examples in there, from trade style businesses through to professional services. Greg Alexander was another guy, 16 mil but sold his company for $160 million. Fabulous story. So pop onto the webinar, pop onto the podcast, I should say. There's a lot of stuff there that I'm sure you'll be able to pick the eyes out of and get stuff that relates to you personally. So thank you all for coming. I've probably gone over a couple of minutes. Apologies for that, but I hope you've gotten some value, pardon the pun, out of this discussion around valuation. And as I said, look, we're here if you need any more help. Thanks for joining.